I'm going to stand up here. There we go, that works. Thank you, Anna Karen, that was really insightful. I think it would be great to get, Sijh, your impressions as a borrower of everything that, well, I've said and Anna Karen so far has said about export credit agencies and how they can serve your purpose.
Yes, thank you very much. Good evening to everyone. My name is Sijh Diagne. I'm one of the advisors to the Minister of Economy, Planning and Cooperation for Senegal. And part of my role is to work a lot with export credit agencies to do a lot of transactions. So let me just say that it's an honor for me to be here among partners, development partners, especially on this topic on climate finance. As you know, climate finance today, less than 3%. Africans do less than 3% of carbon emission, but climate change disproportionately affects us. So we see more and more temperature rising, sea levels rising, a lot more drought. And if you put a gender angle to it, you then start to seeing that women are much more affected because you have a lot more women in, let's say, agriculture, subsistence agriculture, which with drought undermines their ability to finance themselves, to make ends meet. And as well, if you're trying to build an inclusive economy, you need to put that as a lens in order to develop and finance your economies. And so when we put that together, climate finance is certainly at the heart of one of our priorities in Senegal today. So let me just say that it's important for us, and it's something that we are actively working on to get. Accessing climate finance is always a challenge. So today there's a cornucopia of different partners working on that. So coordinating all of that study done by the Task Force on Access to Climate Finance, which I was fortunate to be a member of representing Senegal, we just actually unveiled the list of pioneer countries where we're going to be testing our principles and recommendations to improve that access. So that was at 4:30, and we're very pleased that 5 countries will be trialing this. We have so many people working on it, and there's about 16 on average for developing countries. So coordinating that, harmonizing that, having the same understanding, having the same guiding principles is a challenge, and we're hoping that the work that we're doing here is going to go a long way towards helping with that. I want to address a couple of things in terms of financing. One of the things you said is you have to take a long-term view. We could not agree more. Today, unfortunately, the reality is the export finance, the underlying backbone are the OECD rules, which guide the local content requirements, the maturities, the insurance premium. We still believe that the insurance premium is based on the perceived risk. Whenever you think about a lot of African countries, there's a big gap between the perceived risk and the actual risk. So we get deals that are priced a little bit higher than the underlying things. And it's on us, both as governments, to de-risk some of that. I think you mentioned some of those risks in order to attract more private sector money. Today, there's trillions of untapped private sector money, but private sector needs guarantees. They need financial and social returns, but the financial return we cannot undermine. We also know that doing climate finance is a little bit more expensive. These are new technologies that are more expensive. Over time, the cost will go down. But today, if you want to take a long-term view, it can't be the general 10, 15 years that we have on the OECD. It's at least 30 to 40 years. We cannot still have the maturity, the insurance risk premium of 10% and above. It needs to be much less than that. So there's work that I challenge on the ECAs to see how can we improve the maturities, the risk premiums, the tenors, and the interest rate that you're charging us, because ECAs are a very important instrument for financing our development. ECAs have been partners. It's not just about an export credit, a foreign company coming in to do business. It's about the economic cooperation between two nations that underlines the effectiveness of ECA financing into developing countries. And that spirit, unfortunately, sometimes with these stringent rules, which do not necessarily match the assets that you're trying to finance. If you're trying to finance a rail project, the economic benefits are not going to be seen for at least 20 to 30 years. But if you're doing the financing, you only get up to 10 to 15 years, which already on a borrower's perspective, you're already starting to pay without even seeing any fruits of the work. And you have to use your balance sheet in order to do that, as opposed to doing a project finance, which is a project cash flow that is expected to be paying back the debt. And that's where we wanted to move. For the case of Senegal, we just unleashed a new PPP framework, which will allow us to do more public-private partnerships. And that's an opportunity for ECAs to play a larger role. We believe in ECAs as a catalyst. We can use the newly allocated SDRs in order to do a blended finance. So how about leveraging the SDRs, which are basically free money that a lot of the G7 countries have used, blended with your existing terms so that we can have a much more longer tenor, and those will correspond to the more real projects' economic life cycle. So that's the challenge that we have for you guys. Thank you.
Fantastic, Sheikh. I think